Stocks in Asia extending gains overnight. And on our show yesterday, hopefully saw billionaire investor David Tepper who discussed the reason for his buy everything China moment.
So the question was China going to do the things that you want them to do? Okay, are they going to do the easing measures that you want them to do? So, yeah, they came the other day, and what's his name, Pan Gongcheng, and I apologize because I can't even speak English well. You know, he came out, and he was, like, jovial. It's like, whoa, jovial, saying we're going to cut, and we'll give you more. And he said, we'll do more and more if needed. Now, the Chinese to say we'll do more and more if needed, they don't say that because it's not been healthy to say those sort of things in China. But they said that the other night, and I listened very carefully what government officials say. So I took it that they did a lot, they exceeded expectations, and he promised to do more and more and more.
And for more on whether China is a good bet right now, let's bring in Conrad Saldanha, Senior Portfolio Manager on the Emerging Markets Equity Team at Neuberger Berman. You already knew all this stuff, didn't you, Conrad? You're already like a 1,000,000% long in China.
So we're long, Joe, but we are slightly underweight China because we don't own the cyclical stuff. So I heard David Tepper's comments. Obviously, with the Fed cut, it gave China a little bit more of breathing room, right? And you saw the PBOC Act. Subsequently, you saw the Politburo the next day, and now people are waiting for, if you call it the trifecta, a lot of the fiscal stimulus that's yet to come. So we need to see that really manifest its way out. But you've already seen that at least it's put a floor in terms of the stock market, which we all know China's massively underperformed. And there's valuation opportunities here for China. But this is not an overnight flip the switch, if you will, on an economic basis. I just want to put that out there, that we do have nominal growth, which is slowing down. And especially when they look at real growth, has been an issue for China. In particular, when you come to next year, right? When you look at the export segments that have done well, the base effect starts to be trickier into next year. So I do think there's a bit of panic here. There's a little bit of a coordinated and concerted effort by the Chinese authorities that you haven't seen for a long time, which is what is giving impetus to the market at the moment.
But you need to see it in the underlying fundamentals of the entire country. You need to see some of these actions actually succeed. So that's your point. Then let me ask you, Conrad, listening to Tepper yesterday reminded me of like New Year's, where, as the sun moves across, or actually the sun's not moving, we're the ones moving, but each area, has a different time when they celebrate the New. He did that yesterday he went China, Japan, Asia, Europe, and finally ended in the United States, where he didn't seem that quite as enthralled with, I guess, valuations at 21 times earnings with some of the other parts. What is your ranking of where to invest in emerging markets around the world right now?
So when I look at globally, you need China to start to pull through, right? Otherwise, literally, it's been one engine driving, I would say. The second one, it's the U.S., right? And it's been AI fueling that rally in the U.S. in particular. India is the other market where we're structurally positive long-term. Now, valuations, just like the U.S., at the higher end versus history. But that's another market that is really compounding and worth investing for the next 5 or 10 years. In the meantime, with China, maybe with those deflationary forces that we're seeing, if that starts to improve, that's good news broadly for emerging markets. So as much as people might be underweight and don't own China or excluded China, for emerging markets as an asset class to work, as well as for a lot of the cyclical elements globally, China needs to get its act together. And once you see that deflationary forces starting to abate, I think that's good news globally for markets, in particular for the value-oriented markets, the cyclical markets, and emerging markets where we've been kind of hostage to the Fed right now. There's a lot of real rates in emerging markets. And I broadly feel that EM has been a dead asset class. More for external factors, that seems to be turning at the moment. And I do feel that with the Fed cut that gives a little bit more stimulus to emerging markets. China is the deep end of the valuation spectrum, which you're starting to see that get repriced now, given local policy support. But you need to see that consumer confidence come back into China, given the stock market, which is easier and quicker to implement. But importantly, it's the property market. We've been talking about the debt issues in the property market, and that needs to turn around. In particular, support for the private sector is super important for China right now.
Did you hear his comments on Japan as well, Conrad? Do you agree with that? Or do you avoid Japan?
So Japan's not an emerging market. So I've done this for 30 years. I've done Japan as well. And I think you're seeing a sea change in terms of Japan, in terms of corporates trying to get more profitable. It really helps with the activism coming out. And there's some really great businesses in Japan. Valuations are supportive. And now you've got them starting to get more shareholder friendly. That's similarly with China, what you're seeing, with especially in the internet side, right? They're listed in the US, these companies. They're generating tons of cash flow, and they are paying it back to us. So shareholder return is getting very important in China. Importantly, that's happening in Japan. And guess what? Korea is also taking notice with their Value Up program. So that's good news for us as minority shareholders in a lot of these businesses, where you're starting to see that shareholder return come back. And Japan is very much in that, given that it peaked in the late 80s. And the valuations are finally supportive, and there's an alignment of interest coming through.